All right, Dave Gannon is going to do the single audit. This is something we haven't really talked about in quite a while. There's been quite a few changes in what we're required to do with our grant programs as we administer the grant programs. Unfortunately, DLGS hasn't provided any guidance, so I'm very happy to have Dave here tonight, or today, seems like tonight, to give us that guidance. Dave is with, who are you with these days? PKF O'Connor as an auditor. Dave has been very active in the audit community, chaired the CPA group of auditors for a couple of years, and just been very involved throughout his career. Does a wonderful job. I'm sure he's going to do a great job here today. Thank you.
Good morning. I'll be honest with you, this is the first time I've actually come down to the GFOA. And as I walked in, I saw the bar of mimosas and Bloody Marys, which I've never seen before at a conference. So good job for that. So I'll take you through, just generally speaking, the new uniform guidance, kind of discuss with you some of the auditor's requirements so that you kind of get an understanding of what we're doing, why we're doing it, and then get into some of the more compliance attributes and some of the things that you're required to have in place to make sure that you're effectively managing your federal programs and complying with federal requirements. Just an overview, the Single Audit Act has been around for a long time, since 1984. It's the federal government's way to ensure that the federal awards that they're providing to state and local governments, institutions of higher education, not-for-profits, are expending the funds in accordance with their requirements. Obviously, the federal government doesn't have enough federal auditors to ensure accountability and compliance, so that's kind of pushed down to each auditee, each recipient of the grant, and their auditors. When are you required to have a single audit? Any times in which you have $750,000 of expenditures of federal awards, you're required to have a single audit. In the past, it used to be called an audit in accordance with OMBA 133. That language is now outdated. It's now in accordance with uniform guidance. When the uniform guidance came out, one of the hopes was that they wanted to accomplish was reducing some of the burdens of having a single audit. So where organizations didn't have a lot of federal awards, they were hoping to reduce that burden on them. So the threshold used to be $500,000, and now it's $750,000. As auditors, when there's a single audit required, what are our requirements? Well, we're supposed to, we're required to provide, do an audit of the financial statements so that we can issue an opinion stating that your financial statements are in accordance with the government generally accepted accounting principles. Obviously, for New Jersey, municipalities and counties, that's not the case. But since the accounting basis is required by law, by your regulatory requirements, that's okay. We're also required to assess the internal control environment of the auditee to evaluate whether you have controls in place. It's important to note we don't give an actual opinion on your internal control structure. We just perform testing, and if we find material weaknesses or standard deficiencies, we're required to report those to those charged in governance. The third requirement that we're required to do is give an opinion on compliance. So actually looking at the programs that we're required to test in that year, and actually giving an opinion on whether you complied or did not comply with the federal requirements of those grants. Very important, there's a time frame in which the single audit has to be complete and transmitted to the federal government. A single audit must be complete by 9 months after year end, and the reporting package that has to go to the federal clearinghouse has to be submitted to the federal government within 30 days of audit completion, actual physical receipt of the audit report. So it's very important to know it's the physical receipt of the report, not necessarily the date of the auditor's report. However, several years ago, auditing standards changed where, it used to be when the auditors left the field, let's say on April 1st, but didn't get around to issuing their audit report till June 30th. The date of the report would be April 1st. That's really no longer the case anymore. You can't have audits sitting around for months on end. That audit report date really needs to be very close to the time of when you actually issue it and you receive it. But it's very important that the whole submission process is now electronic. So both the auditor and the auditee both must certify and review the data collection form. That gets submitted to the Federal Clearinghouse. Appended to that form is the PDF of the financial statements. That PDF has to be readable and searchable. And if there are audit findings that relate to your federal programs, the corrective action plan also needs to be appended to that reporting package. If you have findings that are non-federal award related, those don't need to be included in the reporting package. But often not, sometimes people forget the corrective action plan and the reporting package isn't complete. If you don't make the 30 days, that's a significant issue. You become a high-risk auditee, which we'll talk a little bit about a little later. But it's very important to get that done in a timely manner. The other thing that's very important to understand is that these documents are public. So it used to be on the Federal Audit Clearinghouse that the public could only look at the form. Now they can look at the financial statements as well as the corrective action plan. So one thing that you have to really keep in mind is, the personally identifiable information. You want to make sure that, however that audit finding as auditors, but also as the auditees, if that finding has information that could identify an employee, by name, or you don't want to include certain information that may be sensitive, you have to be cognizant of not having that information in either the report or the corrective action plan that's going to get submitted, because you don't want to have that personal identifiable information up on the website inadvertently. So several years ago, there was a lot of different circulars, A133, A22, A87, and whether you're a state or local government or a not-for-profit or a higher education unit, you kind of followed those different cost circulars. And there was not necessarily, they weren't all uniform. So if you had payroll costs, how you documented those payroll cost charges for a local government versus a not-for-profit versus a higher education unit, they could all be different for the same type of expenditure. So one of the things that the federal government wanted to do was just try to consolidate everything into one spot, that being called the uniform guidance. That was their whole purpose. The uniform guidance has been in effect since December 26, 2014, so any audits after that point, uniform guidance is the required literature. But of course, with everything with the federal government, they try to simplify it, but over 18 federal agencies have taken exceptions to parts of the uniform guidance. And those exceptions are, run in the hundreds, and they cover 42 pages. So, they try to simplify things, but in the end, they still made it complicated for both auditors and auditees on what we're supposed to test and what you're supposed to comply with. So just briefly, just to talk a little bit about just the structure of the uniform guidance. Don't want to talk about this too much, but it gives you the general definitions, the provisions, some post-award requirements for the auditees, cost principles, meaning how you deal with procurement, how you document capital assets and personal services, the audit requirements, and of course the compliance supplement. Again, the next two slides just kind of delve into the audit requirements section. Some key terms: federal awards, federal expenditures. And again, anytime you have more than $750,000 of expenditures, you're required to have a single audit. Every federal program has a CFDA number. That's the identifying number. That's very important when you have a single audit. It goes on both the data collection form and the next item, the schedule of federal expenditures. So anytime you have a federal single audit, you need to have what's called the SEFA, Schedule of Federal Expenditure Awards. If you don't have a single audit, you're not required to have this as part of your financial statements. There's different, when we do a single audit, we're not required to actually audit every grant program. There is a process that we have to go through in order to determine which programs that we test. Generally speaking, they fall into two different buckets: Type A programs or Type B programs. Type A programs are the larger type programs over certain thresholds. Type B or anything under that. Major programs are ones that we test. Non-major programs are ones that we don't test. Another very important kind of concept to understand is when you have an expenditure, what constitutes an expenditure. So certainly, if you have payroll charges and you have purchase orders, those are obviously their expenditures. But if you have a subrecipient, if you have actually engaged in another organization, let's say a not-for-profit, to administer a program for you, dispersing those funds to that subrecipient is an expenditure for you. Even though, let's say that's their expenditure, they're going to spend the money, we're just flowing it through to them, that's still an expenditure to you that's going to trigger, and we'll talk about it a little later, requirements that you have to follow. Loans or loan guarantees. So, obviously New Jersey EIT or Infrastructure Bank or whatever they're called now, if they give you no interest or low interest loans, that has to go on the schedule of federal awards. That becomes part of the single audit. It's very difficult sometimes when you get those EIT loans. They don't do a very good job of communicating to either the auditee or the auditors what portion's federal and what portion's state. And they actually came before the government group of the NJCPA not that long ago, and they kind of gave us a presentation. And they even said that sometimes it's a couple years after the fact when they decide what the allocation is. So obviously, as an auditor, when we're doing the single audit, we do our best effort, best guess, and a lot of times we do 50-50, 50 state, 50 federal, in order to determine the single audit for each one of them. But it can be difficult. DOT is another one. Often enough, DOT has federal funds as well as state funds mixed in the award. The grant award letter doesn't necessarily say it. Often enough, as auditors, we get the GNO6 form at the end of the year from Treasury that shows all the disbursements Treasury made out to your local unit, and that gives us some information on whether it was a federal or state. But then, that also has to take into account. I've seen open space grants that have been both federal and state. Sometimes the award letter is not enough. Sometimes there's an award agreement. And in that agreement, if you dig deep enough, there's some information on whether it's a federal or state award. So it's important to understand what the composition of the award is. Otherwise, you could be doing the wrong single audit. You could be doing a federal single audit where you should be doing a state single audit. Food commodity is not so much applicable for municipalities, but I do know, sometimes cities run summer programs in which they provide food. If you're being provided food from the New Jersey Agriculture Department and they're giving it to you, or you're not paying a significant amount, that's considered a federal award. If property is donated to you, that from a federal organization, that's considered a federal award. So again, just so you just have some information on what, how the auditor decides what to audit. Again, type A programs, generally speaking, anything over $750,000. But when you get over $25 million, it starts to go up. If you're at $100 million, it's $3 million. If you're the state of New Jersey, where you're billions of dollars, your type A programs are $30 million. So that kind of gets us an understanding of the big programs and the small programs. And then we take an approach to determine which ones we have to audit. So we don't have to audit, again, all the programs. We have to audit some of the programs. So we have to identify high risk and low risk type A programs. If it's high risk program for type A, we have to audit it no matter what, regardless. And we'll get into what constitutes a high risk or a low risk. Then we identify our high risk Bs. Even if it's a high risk B, we don't necessarily have to test it. But if there's a number of low risk A's, we may have to test it. And I don't want to get into the weeds on that one. But so for a type A program to be considered high risk, generally speaking, the number one reason why a program might be considered high risk is that it hasn't been audited in the last 2 years. All type A programs are required to be audited at least every third year, no matter what. If it was audited last year and there were significant findings, so if there's material weakness, if there was an exception to compliance regarding the requirements, or if there were question costs that were over 5% of the program expenditures. Those, even though they were audited last year or the year before, they have to be audited again. So even given that, once we determine that, which ones we have to test, then we need to also look to see there's minimum thresholds in which we have to test. So if you're high-risk audit T or low-risk audit T, the percentage is different. If you're high-risk audit T, we're required to select grants that at least get coverage of 40% of the expenditures. It doesn't mean that we're auditing 40% of the expenditures 100%. It means that we're doing sampling over 40% of the expenditures. If you're low-risk audit T, the amount's 20%. And again, when uniform guidance came into effect, they did try to streamline things. They raised thresholds. It used to be 50 and 25. So again, they were really trying to reduce the burden on units that had smaller amount of expenditures and really focus on the organizations that had the bulk of the expenditures for federal awards. So what constitutes a low-risk audit T versus a high-risk audit T? Which would determine the percentage threshold in which you'd have to look at. Again, in the last 2 years, you have to have had a single audit. So if you have a single audit 1 year but not the next, and it just kind of rotates, then you just may be a high-risk audit T just by virtue of that. The single audit had been done the last 2 years. Unmodified opinion on the financial statements, whether it's according to the GAAP or the regulatory basis. So let's say you don't update your fixed assets, or you don't get a GASB 45 or what's now a 75 OPEB calculation done because you don't want to spend the money. Well, the auditor has to take a modification to the opinion because on the regulatory basis, you're required to have that. So under that circumstance, you're considered a high-risk audit T because you're not receiving an unmodified opinion for that basis of accounting. No financial statement material weaknesses. From a grant perspective, you couldn't have had material weaknesses or non-compliance or question costs that exceed 5%. Timely reporting of the reporting requirement to the clearinghouse, that has to get done timely every year. Otherwise, if you don't do it timely, you become a high-risk audit T. There's no waivers to any of these, except for only a few years ago, the Federal Audit Clearinghouse website got hacked several times. And it took them months upon months to figure out and fix it. So during that time period, obviously you got a waiver because you couldn't submit it. But then you had 30 days afterwards, and it happened twice within like a 6-month period. So this is really more now you guys, what you're required to do and what we're required to look at, internal controls and compliance. So one of the things the uniform guidance focused on was really the concept of, do you have an internal control structure in place in order to ensure that you're going to expend federal funds in accordance with the compliance requirements of your grant agreements? That's what they're focused on. There's something called the Green Book. It's really focused for federal agencies, but they would like you to follow that, should or may. Should doesn't mean should in this case, should means may. But they would like you to follow it so that you have a good internal control structure. Also, they want you to follow COSO, which we'll get into next. COSO has the concept of these 5 integrated components of internal control. You have the control environment, which is the tone at the top. How important does management or the governing body take seriously policies, procedures, processes? Are they quick to just override them? Then you obviously don't have good tone at the top. Risk assessment, and again, this is an area that most local units, whether you're a school district or a town or a county, you don't really do risk assessments. You don't really take the time, because you have so many other things going on, to really sit down and think, where could something bad happen? Where could things go wrong? Where could theft occur? Where could non-compliance occur? And that's something that, generally speaking, you should be thinking more about, where things could go wrong, where theft could occur, and so on, just even outside of federal awards. Control activities, generally speaking, local units are great at that. You have processes, you have timesheets, you have salaries are approved, you have collective bargaining agreements, you have purchase orders that are required to be approved and reviewed. Control activities, typically local units have strong control activities. Information communication is, how do you actually communicate out to all your employees what's required, when it's required, and monitoring. Again, another area where, because you guys don't have normal internal audit departments, there's really not a strong monitoring function within any local unit. Monitoring is like, okay, you have controls in place. What are you doing to make sure they're actually working? It's not so much say, okay, I have this requirement, but I'm not going to do any follow-up to make sure that that requirement's occurring. So those are the five, components of internal control, or an effective internal control structure. Uniform guidance also discusses certain required policies. And again, what I found is not always that these policies are necessarily formalized. They may be loosely put together. You're really required to have a procurement standards policy or purchasing manual. And that purchasing manual has to have some discussion of federal requirements as well. It's not so much just to focus on state requirements. You're required to have a conflict of interest policy, a payment policy, and allowable use of funds policy. Those are the required policies, but generally speaking, do I see all that at all places? Definitely not. These are the types of compliance requirements that the federal government, generally speaking, wants us to look at if they're applicable to the grant that we're auditing. It goes A through N. You'll see a D and a K missing. It's not that I made a mistake, it's just that when they did uniform guidance, there's certain ones that they took out that they didn't replace in the reserve for future use. D was Davis-Bacon, so the certified payroll that you get when you have road projects, that got put into special provisions down below. And K was housing and relocation, which doesn't come up a lot. And again, if it came up, it would be in special tests and provisions. So one of the things that the federal government also want to do is make sure that there's consistent procurement policies in place. As a local government unit, obviously you have local public contracts law. If you're a not-for-profit, you don't have local public contracts law. You don't have a uniform standard. So I'm going to talk about this procurement a little bit, but generally speaking, the state requirements are much more stringent than the federal requirements. So as long as you're complying with the state requirements, you've complied with the federal requirements. There was an exception to this for a couple years. It's called so there's 4 or 5 different types of purchasing requirements that the federal government put in the uniform guidance. One is the micro purchases. It's for any purchase that don't exceed $10,000. But that $10,000 was only done this last June. From the time that uniform guidance started, at the end of 2014 through June 2018, the threshold was $3,500. So obviously the $3,500 is less than most of your quote thresholds. So if you'd purchased if you'd made a purchase using federal award and you didn't get quotes for something because you didn't think it was over your threshold, you may not have been in compliance with the federal requirements. Now that kind of goes away with this increase in June. I guess you could still have some non-compliance for the first 6 months of the year potentially, but small purchases to the federal government is anything up to $250,000. So clearly you're never going to hit that threshold. Anything bid, you have to do anything over $250,000, you have to bid. The only thing that you should be concerned about with the federal procurement policies is that they do want the process that you have to be competitive. So if you're going to use federal awards to buy something that's sole source or use it to fund an emergency, you really need to take care of documenting that. You really need to make sure that you're documenting exactly why it's a sole source, why you couldn't get other price quotes. And I've heard sometimes the explanation of, well, when I did this federal grant award, this is more on the education side, but when I did this award, I put the name of the vendor in the grant award, in the grant application, telling them who I was going to use. That's not enough. That's not, like, the federal government's not necessarily approving that vendor to be used for that award. That's just not enough. So you really got to take care to make sure that if you're really going to use federal awards for a sole source or something that is not competitive, you really need to take care to make sure that you've really documented it. Do a resolution memorializing it by the governing body so that it also covers you, to make sure that no one can come back to you and say no one else knew. But that's one of the things that you have to be real careful about. One of the other concepts that are really important is the federal government obviously doesn't want you to be paying a vendor that's on their suspended or debarred list. All right. So anything over $25,000, generally speaking, you're supposed to look and make sure that they're not suspended or debarred. Obviously, the threshold, you might want to be a little lower than that. But you really can't hire vendors that are debarred. There's a website up there that provides you with some, the spot in which you can actually go look and verify. So what are some areas of common non-compliance? I mentioned it before. One area is that the written policies and procedures, just speaking, are generally not there sometimes. So that's an area of non-compliance. If they use the federal awards for a sole source, but it's not really documented well, showing why exactly it's a sole source, and there was absolutely no way to get a quote from somebody else, that's an area that's of risk. One other area of risk that often local units are really good at looking at the state debarred website, but not the federal debarred website. So it's one thing to say, okay, I looked on the state debarred website, they're not on that list. I've never been able to find anyone that could tell me that the two lists are the same, or that the state makes sure that everyone on the federal debarred list is also on the state. No one's ever been able to tell me that. Even in contract documents, sometimes there's a certification by the vendor, I'm not on the debarred list. And again, a lot of that times is the New Jersey debarred list, not the federal debarred list. But again, if you're using federal funds for procurement, you need to make sure that they're not on the debarred list. I guess before I move on, I should have said this before, but is there anytime there's any question or anyone wants to make a comment, certainly just interrupt me and we'll talk about it now. So if there's any questions of anything I've gone through before I keep going, clearly go ahead and ask it. All right, cost principles, indirect cost rates. On a municipal level, I don't see this a whole lot. Maybe on the county level, it's a little more prevalent where you have indirect cost rates. Maybe just an important thing to note here is that there's a de minimis indirect cost rate that the federal government provides of 10% if you don't want to go through the process of determining an indirect cost rate. So there is an option there that you can use that 10% rate. Compensation, so how you document the compensation that you're charging to these grants. Again, before there was very prescribed regulations in these circulars, and they were very different in the different circulars by the different organizations. Uniform guidance kind of like made it like gray. They were specifically not specific. And the four standards in which they provide you are, charges of salaries, must be based on records and accurately reflect the work performed. You have to have a system of internal controls in place to make sure that people getting paid are getting paid the right amount for work they perform. They have to be part of the official records of the organization, and it has to reasonably reflect the total activity of the employee. So if you have grant-funded employees, even if they're full-time, you still need to have some type of documentation showing that, yes, they were working on this program. They weren't working on something else. Whether it's a 50% funding or 100% funding, if you're using federal awards to fund someone's position, it needs to have documentation reflecting that. Sometimes I see where it's just easier for a town to say, okay, well, this person is making X for the year, that's the budget, and I'm going to just charge the grant for the budget. But let's say someone goes out for a leave of absence for 2 months and they're not paid. Well, you have to go back and look at the end of the year. You can't just go based on the budget. You have to do some reconciliation of what the budget was, what the actual was, to make sure that the federal government's only being, the federal award's only being expended for the actual time incurred, the actual amount paid. So some areas of typical non-compliance. So again, absence of review of timesheets. So is the person that's supervising, are they signing off on the timesheet? The employee doing a timesheet with no one reviewing it or approving it isn't good enough. Or the time records support the actual charges. Again, when you have someone that's allocated, to give you an example of, let's say the person that handles the housing voucher program also has some responsibilities for the CDBG program. And she generally says, well, I spend 50% of my time on this, and I spend 50% of the time on that. That's really not enough. There needs to be some accounting for that time on a weekly, bi-weekly basis, actually proving to the fact that it's 50-50. And again, maybe during the year for ease, you do 50-50, but at the end of the year, you need to do some kind of reconciliation to make sure that that's what it was. And if it wasn't, make an adjustment to the grant award, or the grant expenditures so that it's appropriate. Or you charge somebody or expenditures to a program that just wasn't related to the program. This is a common one. The last two bullets are kind of very similar. Expenditures charged to grant via manual adjustment. Or, let's say you charge something initially somewhere, but you say, you know what, I could have charged it to the grant, and you make a manual adjustment and just move the charge. Well, if you don't really have a good documentation trail for your journal entries, that's a cost that could be questioned because you don't have any evidence as to why it was moved there. Same thing with just cost transfers with current and grant fund. Let's say the Safe and Secure grant. $60,000 for a cop salary or $80,000. And often enough, what I'll see is in November, debit grant appropriated reserve $80,000, credit police salary and wages $80,000. That's not really that's not documenting what he did or why that person was charged to the grant or who it was. Didn't identify anybody. I know, with local municipalities especially, the oversight from the state government is not the best. Whereas in education, these school districts, the Department of Ed has a very robust compliance system, very robust routine of going out and auditing these individual school districts. Generally speaking, so often that, you're a subrecipient on some of these awards from the state, and they're supposed to have some understanding of what's going on, and on the DCA and the division, they're just not focused on it, besides collecting the audit report at the end of the year. They're not really looking and paying attention to it. So at that point, it becomes hard to be very stringent with yourselves because they're not paying attention to it. Cash management, you're really supposed to minimize the amount of time in between when you expend funds and when you draw down on funds. Again, it becomes different if you're being advanced funds. But if you have a drawdown grant, you really shouldn't be drawing down more than you spend. Some areas of non-compliance that typically happen, again, no policy procedures of why you draw down or when you draw down. Did the person that was supposed to be doing the drawdowns, were they using a personal email address instead of the business address? Were the drawdown requests not approved by anybody? So if it wasn't the CFO, if it was just a clerk, did the CFO review what the clerk was drawing the funds down on? Again, if it's a reimbursement-based grant, then you shouldn't have drawn down more than you spent. Those are just very common things that happen, common sense, but common things that go wrong. Everyone's favorite topic, fixed assets. Technically, if you buy capital assets using federal funds, you are required to tag them and say that these were purchased using federal funds. The threshold is for capitalization is $5,000, and technically you're required to have a physical inventory of those assets every 2 years. I'm sure that doesn't happen very often, but that's the requirement. And honestly, the common error that happens is that, fixed assets are an afterthought. It's an audit requirement, and no one's really paying all that much attention to it. But just, again, if you're not paying attention to it totally, at least if you're buying a number of things with federal awards, then it's important to make sure that you're accounting for those at least. Period of performance. I mean, how often do we look at our grant reserve schedules in the audit and we see, grant awards still open from 2004 unspent, and we haven't canceled it, whether the money was, charged somewhere else and didn't get to the right spot, whether it was not charged. In reality, if it's a federal award, there really was a period of performance in which you were supposed to follow. It wasn't just I'm going to give you the grant award and you're going to have it forever until you decide to spend it. And the risk could be is that, again, if it's a reimbursement type grant and all of a sudden you're not really paying attention to that, and then all of a sudden 5 years later you say, oh, I got this money here, and you spend it, charge it, but then you can't actually go get reimbursement for it because the federal government's going to say, sorry, there was a grant period and you went through it. There was no extensions of time requested or given, and then you have a charge that has to go back to the current fund. And and again, too often I think we could all look at our audit reports in our financial statements and we'll see years and years of grant awards open, and a lot of it's on the state side. And again, the state's not paying attention to this, nor are they providing solid, clear guidance as to what the period availability is. Reporting, again, just sometimes grant awards require specific reports to be done outside of just drawing down funds. And it's just important to note and look through those grant agreements to make sure if there are special performance type reports that have to get filed, when they need to be filed, and what information has to be provided. And if those reports do have to be done, making sure that the documentation that you use to support that report gets filed away. Another concept of subrecipient monitoring, and again, it may or may not affect you, but if you have a program in which you're, a great example is the counties. Sometimes the counties are the prime recipient of CDBG funds, and they provide to each town in the county a subaward. The county is the prime recipient of the grant. They have subrecipients, the towns. The towns are required to have to spend those funds in accordance with those grant agreements for that CDBG award. The county has a responsibility to make sure that they're looking at how you spent the money. It used to be that if you just asked for the audit later on, and you made sure that there was no findings in there, that was enough. But often that was well after the fact. So really, there's more onus on those that are the entity that is passing through the funds. You're really required to make sure that, okay, if I'm giving them these funds, one, you don't want to advance fund them necessarily. You want them to come back to you and show you what they're spending it on, provide you documentation. And then in the end, you want to make sure that, when you get that audit report, make sure they're having a single audit done when they're required to. You also want to make sure that when you get those audit reports back, and if they have significant findings in the grant award section, you may want to consider whether they should get awards next time. And that may be difficult with counties and towns, but if you're a city or so and you have not-for-profits that you're allowing them to run programs for you that they're subrecipients, you really should think twice as to, okay, if these people aren't spending money in accordance with the way they were supposed to, should I continue to give them subawards? And that's something that should be looked at. The other thing uniform guidance kind of went through and gave a little more clarity on is when you're a subrecipient versus when you're a contractor. Because as simple as it sounds, sometimes when you really look at the basis of the agreement, it's not all that easy to determine. So in essence, subrecipients, they're running a program for you, they're determining eligibility, whereas a contractor, you're providing them for a service they're performing. So it's that's just the kind of like the little differences on it. Just generally speaking, again, grant receivables and appropriate reserve balances. Just, in general, towns and counties need to do a better job of really cleaning those schedules up, making sure that they're valid receivables, that they're still to be drawn upon, or, if the appropriation reserve is whether those expenditures are really charged in the right spot to use those funds. What are findings? So there's a certain threshold for findings. So generally speaking, if you do a single audit and you find questionable expenditures, and those questionable expenditures are over $25,000, that triggers a single audit finding. If it's under $25,000, the auditor may say, okay, maybe it's another matter. Maybe it goes in your comment and recommendation section and doesn't necessarily get reported to the federal government, but if it's over $25,000, or if you're doing sampling, because you're doing sampling and it may be pervasive, you may need to extrapolate, it may be likely cost over $25,000. That's a finding. If you have significant deficiencies or material weaknesses, those are findings for the single audit, or just material noncompliance of a certain requirement. So key changes made to the 2018 compliance supplement. This is the first year in which this changed. It's called the skinny supplement. So every other year, the federal government always re-looked at the whole compliance supplement. As you can see, the 17 supplement was almost 1,700 pages. This is the first year that they just looked at areas where there were substantial changes. And they reissued just those changes that were substantial in the 18 year. So the 18 supplement is only 251 pages. So for auditors and auditees to understand what they're required of, they actually need to have both. And they need to look at both to determine what the requirements are. The word was that they just didn't have enough time to go through it all for some reason this year. So it's available at the OMB website. For auditors, the ICPA has actually put out a tool for us to help us better match up and understand all the different requirements and how to use both. New Jersey is a little bit unique. They actually require a single audit as well. Not all states require a single audit or some variation. Connecticut requires one. That's a lower threshold. New York doesn't require one except for DOT type grants. So every state's a little bit different, but the state of New Jersey does require also a state single audit. State single audits are separately assessed. So if you have over $750,000 of state expenditures, that kicks in a state single audit. Largely speaking, the state guidance is encased in Circular Letter 1508. And pretty much what it says is follow the federal guidance with some exceptions. Also requires an audit in accordance with government auditing standards if you have over $100,000. That's more for not-for-profits and for-profit entities. As a local unit every year is supposed to have an audit done in accordance with government auditing standards as required by administrative code. Just real quick at the end now, audit quality study. Just so you guys know, you guys hate being audited, I'm sure. Auditors do as well. So we're also required to have a peer review done every 3 years. That peer review process has gotten more and more stringent and more risky for us, actually. So even after the peer review is done, very often enough, the AICPA says, you know what, I want to look at what you looked at, peer reviewer. And I want all that documentation. And I'm going to independently assess whether you did your job as peer reviewer and you really, if there was a deficient audit, you said it was a deficient audit. And more likely than not, there was in 15, they looked at 87 single audits, and there was 48% of them were non-conforming. Not unreliable necessarily, but non-conforming. That there was some issues there that perhaps were pervasive that should have been reported. So, just from our firm's perspective, we actually had an AICPA representative on site when our peer reviewer was there, and they were there for 2 days. And they actually, when one of our peer reviewers was done with an engagement, the AICPA would just randomly select it and say, okay, I'm going to look at it now and make sure that you did it right. So the scrutiny on the auditors is at an all-time high. In 2007-ish, there was a national statistical sample done by the federal government, again, looking at all the different auditors across the country to verify that they were doing the right audits. That hasn't been done since, but it is going to be done again, most likely in 19. So it's, again, another layer of scrutiny on the auditors. Audits, government audits and single audits, it used to be non-risky. What we always looked at is that's not a risk. It's low-risk work. It's not low-risk work anymore. There's a lot of people looking at our work. And then just lastly, the Yellow Book, Government Auditing Standards, came out with another revision this past year. They continue to look at auditor independence and make it more and more stringent upon us to document that we're independent, mostly as it reflects to that when we put your financial statements together, we have to really look hard to make sure that management at the entity has the skills, knowledge, and experience to do it, even though they're not doing it. With that, any questions? Off to the next one.